Real estate headlines are definitely scarier these days. I think right now, interest rates are going to go up, but we don't know by how much or how quickly. If the Bank of Canada gets more aggressive with rate hikes, psychologically, that's going to cause a lot more fear, which will shake up the real estate market in the short term. We also know inflation is high, gas prices are high, and these things, along with higher borrowing costs, mean that we're likely looking at higher rental property carrying costs for the real estate investor. But then there's also the other side of things. More offices are opening up again and students are going back to in-person classes, and these are positives for the rental market in core Toronto. With so many changing factors these days, it's not that simple when it comes to what returns look like if you're thinking about buying an investment property in Toronto today. So in this video, let's clear it all up. We'll look at upcoming changes to rents, expenses, and appreciation, and then show you what to really expect if you buy an investment property in the near term. Before I start, if you enjoy content like this, don't forget to give this video a thumbs up and subscribe to our channel so you can see more videos like this made specifically for real estate investors in Toronto. Real estate returns come from rents minus operating expenses minus mortgage interest plus appreciation. So let's tackle these one by one. In the rental market, things are getting better. During COVID, there was a huge influx of newly converted investment properties combined with renters leaving the core, which caused rents to drop. Right now, we're still not completely back to pre-COVID levels, but we're very close and the pace of recovery is picking up. In Q1 of this year, we saw a 6.5% annual increase in apartment rents, and condos and single-family homes saw a huge jump of 20%. Currently, TorontoRentals.com forecasts an 11% increase in rents for 2022. Looking at current prices compared to December of 2021, prices have gone up 2 to 3% so far. So this means we still have a 9% room for price growth in Toronto if tenants turn over. Even if they don't, we can still expect higher rents based on a regulated percentage. The guidelines for 2023 haven't come out yet, but given the higher inflation rates and how much things have gone up over history, I'd conservatively assume that this annual rent increase should be around 2% plus. On the expense side, we have operating expenses and mortgage interest. The one thing that we all know is skyrocketing are gas prices, and the market is pricing in an annual 9% increase from this point on. I would say other expenses are also expected to go up, but they look more in line with CPI at around 5%. So overall, we can expect operating expenses to go up by probably around 6% in total. So if we plug in the math, rents going up 2% and expenses going up 6% actually mean not much has changed, with freehold cap rates staying at around 3.7% and condo cap rates staying at around 2.8%. The factor that's probably going to make a more significant difference is interest rates. Variable rates follow overnight rates, and right now the market is expecting a 50 basis point rate hike for Q2, another 50 basis points by Q4, and another 25 basis points in Q1 of next year. So overall, that's a 1.25% increase in interest rates in a year's time. Assuming a loan-to-value ratio of 80%, this will reduce the net income for freeholds from 2.2% to 1.3% of the purchase price. As a real estate investor, we don't just look at net income, and many investors actually feel that cash flow is king. In case you don't know, each mortgage payment includes a portion of the principal that you need to pay back every month. This is not an expense and you're actually building your own equity, but this amount needs to come out of your pocket and go inside that piggy bank each month. The annual principal paydown amount at the start of your mortgage is approximately 2% of your purchase price. Assuming you're going with a variable mortgage at 1.8% right now, when rates go up 125 basis points to 3.05%, your monthly mortgage payment actually stays the same up to a certain point. What happens is that the bank will redistribute the payment breakdown, sweeping a bigger portion towards the interest and shrinking down your principal paydown portion. Because your cap rate doesn't change and your mortgage payment doesn't change, Your net cash flows also remain stable up to a certain trigger interest rate. At the moment, the trigger rate is around 4.5%. When rates go higher than that, the monthly payments won't be enough to pay for the interest portion, so that's when you'd expect your monthly payments to start going up. Just to recap, so far we've covered rental income, which will be compressed because of interest rates, cash flows, which should stay unchanged over the next year, and now we're left with appreciation, which is probably the trickiest part of the real estate equation. Real estate prices have gone up very quickly in the first couple of months in Toronto. Detached homes have gone up 22% since December, and semis and condos have gone up around 13%. That is a lot already, but CREA just updated their 2022 and 2023 price forecast for Ontario. Previously, they expected an 11% increase for 2022 in Ontario, but now it's gone up to 23% for 2022 and 5.7% for 2023. If this pans out, this means detached homes in Toronto are likely going to stay more or less the same by year end, and there's another 10% room for price growth for semis and condos in Toronto for this year. As real estate investors, we all want to make numbers-based decisions, but the reality is that real estate price movements are largely driven by emotions and fear. Right now, the market is expecting a 50 basis point rate hike in Q2, hopefully going up gradually at 25 basis points each time. But if the Bank of Canada gets more aggressive and bumps it up by 50 basis points in April, June, and July, this might be what is needed to rock the real estate boat in the short term. If things get rocky and you're in the market to buy and you meet the right motivated seller and selling agent, then it's very possible to snag a deal with a 5 or 10% discount. Even if detached home prices aren't going to change by year end, you might be able to buy the dip and end up 5 to 10% better off by year end. If you buy a semi or a condo this year and you get that extra 5 to 10% discount plus an extra 10% expected price growth by year end, which means you'd be doing very well with your property price going up 15 to 20% by year end. There are so many scenarios we can play out, going with a lower appreciation rate of 5%, 2%, 0%, or even negative appreciation rates. Honestly, real estate returns nowadays are primarily coming from appreciation, no matter what market you're looking at, and this is our biggest unknown at this point. If we assume the biggest 20% price growth with a semi and a motivated seller, you might get total returns of 21% of the purchase price or a ginormous ROI of 91% post leverage. With a more conservative 5% price growth, ROI is closer to 27%. With no price growth, you'd be solely making money from rental income, which comes in at 5% post leverage. There's that saying, when there's change, there's opportunity. So yes, there is a chance that real estate prices will dip when interest rates rise more, but I don't expect that to last that long in core Toronto based on my previous analyses, which you can watch right here. In rising rate situations, prices in Toronto typically go up, and Toronto has outperformed other cities like Markham, Barrie, Hamilton, and Newmarket in the past. You can also see that Toronto prices fluctuate a lot less than these other markets, which also makes it a lower risk investment class overall. I don't personally like to speculate the market and usually recommend that you buy when you're ready because time in the market always wins. But again, we are in a more volatile time right now, which means it is possible to snag better deals that might come and go pretty quickly in Toronto. If you are monitoring the real estate market and watching for deals, what's extremely important is that you have your financing sorted out right now. Refinancing for your down payment usually takes a couple of months at least, and if you need another mortgage on top of that, you'll need to give yourself even more time because spacing out refinancing and mortgage applications can help you qualify for bigger total amounts. If this sounds confusing and you want a real estate expert to help you figure all this out, our team can help. We can take a look at your requirements and preferences and then walk you through a real estate investment roadmap so that you can secure that perfect investment property right on schedule. After we help you buy it, our team also provides renovations guidance, leasing, and property management if you need it. So just connect with us if you want to learn more about our services by heading to the link in the description below. Don't forget to give this video a thumbs up and look for us on Facebook, Instagram, or LinkedIn if you want to hear from us more regularly. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video. Bye.